All right, so what we're going to do today, and I don't have any PowerPoints or things like that. The next time I come before you, I have this thing that I'm working on that that will require a visual, more visual. So we'll work on that at that time, okay? But what I handed out to you was what I didn't hand out, I think Pastor Terrence and others handed out to you. It's income over time. I thought this was an interesting sheet to take a look at, okay? This is a picture of a person that starts working at the age of 23, okay? He starts out with $30,000 a year salary, okay? We assume that he gets, on this chart, he gets an increase of 3% every year. You're barely keeping up with inflation. Forget bonuses and all that. So when he gets to be 67 years of age, he would have earned about $2.8 million. Wow. Okay? So, I love it. You never realize how much resources flow through our hands. Okay? So over that time, how much resources is flowing through our hands that God has blessed us with, okay? So that's why it's really incumbent upon us to get the tools and the resources that we need so that we're faithful over what He's provided. Because there's probably a lot other things that we could be doing with what God has blessed us with. And last month, we talked about bad money habits. And I'm going to challenge people out here. Yes. Would anyone like to share about a bad money habit that they've worked through or are working through? Give them a moment to share.
Between good and bad. I mean, it's about our needs and our wants.
Yeah.
Yeah, that was one of them, like the car and the house.
Yeah.
But let's see what else was there.
Cable.
The what?
Cable?
Oh, the cable was there. The cable, yes. But, cable, but the credit cards. The credit cards and things like that, yes.
Francis?
Eating out as opposed to cooking.
You said it again?
Eating out as opposed to cooking.
Right. Eating out as opposed to cooking. Okay.
Who said that?
What, you can't cook? There's somebody I can teach you.
You know, but that can even depend on how many it is.
How many what?
How many people? Because sometimes it's cheaper for, like, if it's just 2 people to eat out than to go purchase food to cook.
Depends on how much they eat.
Because you gotta buy the condiments and all that by the time you do all that.
But see, the thing about condiments, they last for a period of time, so you buy it once and you have it for months.
Yeah. Sometimes it's cheaper for 2. It depends on where you go. Sometimes, I'm not trying to educate y'all, cook at home. Sometimes. Not Pastor Cooper because he's in salmon.
Buying up my maid versus a BMW.
Yes, that's true.
That's what I need.
I was thinking,
It's dependability.
even though you shop on the clearance rack, you don't necessarily need what you're shopping for.
Right.
But you think you're getting a good deal because you got it off the clearance rack. I'm just saying.
It depends on if you need it, because if you don't need it, it's a waste
But
of
you don't
money.
need it. So if you're buying something, you know, I got a deal because it's on the clearance,
Right.
but you don't use it, so you really didn't get it.
You wasted money.
Right.
Absolutely.
It's not actual deal, that's
Anyone
the
else?
actual price.
So I bring it.
Want versus needs.
Yes. I bring that up because one of the things that I failed to mention is that as a part of being a faithful steward and trying to, dealing with your bad habits is developing good habits. And one of the habits that I had, in some respects it could be a good habit, but it can also be a bad habit, is that I would not do anything for myself in terms of, it's like I was so tight with everything that I would just do. I would not take any time to really relax and just celebrate myself, okay? So every now and then, I think when you're doing things, you're going along, you need to relax. You need to take some time for yourself. Use wisdom about it, but take time for self-care.
Amen.
Okay?
Amen.
Amen. So I did mention that.
Amen. Yes.
When you say it.
I'm agreeing with you.
Celebrate yourself.
Okay. So And last time we were together, who am I gonna pick on? Pastor Abigail?
What?
You go.
Like she picked on me last time about my air conditioning, y'all.
Yeah, that's a
Pass it
picture.
out?
Yeah, you can pass those out. What that is some of the, we talked about a house. We talked about building a house because the different areas of financial planning we looked at in terms of building a house. We had a foundation. We had a foundation. The foundation was our emergency fund, health insurance, life insurance, and disability insurance. We did, we said what was going to hold up our budgeting was this foundation that we had laid, okay? So we talked, buying a home, college savings, milestone vacations, planned expenditures, that was where our savings and things were going, okay? So in order to not have to undo our savings plan, undo our planning process, we had to have that foundation in case there was an emergency or a need that had to be addressed. Okay, so what we're going to talk about today is that house. But we're going to talk more about the foundation of the house. Because we went through the budgeting experience briefly, so if anyone needs more assistance with that, feel free to see me. Okay? And I can send you my link now and make an appointment. I believe. I can't figure out how to use it, but yeah. But anyway, alright, so let's take a look at that financial house. Alright? So as we look at it, you'll notice that a lot of that stuff is about insurance. How many have auto insurance? Auto insurance?
It's legal not to have it.
Exactly. It's illegal not to have auto insurance. That's why we have it. Okay. And many of us have health insurance. You got health insurance? Okay. What about disability insurance? Okay. And for your job or personal? Job? Okay. Do you know with disability insurance you can never get 100% of your pay? Right, because you never go back to work. So it's designed that you never get 100% of your pay. So that's how they do it, why they do it that way. Right. It's usually about somewhere around 60%, 40 to 60% most places. For short-term disability, for long-term disability, it's somewhere around 80%. Okay, but never 100%. Okay. So we look at the disability insurance, and then something else that is not on here. People typically don't have is long-term care insurance. Okay. So if you're in a nursing home, okay. Otherwise, what happens is that if you end up in a nursing home, the average stay in a nursing home is about 2.5 years. And so you have to deplete all your resources before the state will kick in. They'll all except 2,000. Then the state will kick in. Okay? But let's take a look at why insurance. Why do we need insurance? God is our source. Why do we need insurance? Let's take a look at this definition of insurance. Okay. By the way, this is going to be a two-way dialogue tonight. Right. Insurance.
Just before you share a bit, I just need to say this to you guys. As a pastor, I have the wonderful opportunity to hear more from parishioners than you guys. And there was this Donna who came to see me years ago and says, Pastor, can you convince my mother to get some insurance? And I said to her, well, microphone. Thank you. So I told her, I said, sure. So I called the mother in and I tried to convince the mother that she needs some insurance just in case the Lord should call her home to rest, that she will leave her daughter with a big fat bill. Well, the mother convinced me that she is a woman of faith and she has faith insurance. So therefore, she doesn't need that insurance. As a matter of fact, she was upset with me. It wasn't too long after that she took ill. And when she took ill, the daughter came back to me again. I said, I try, this is not a cult. We can't force people. We encourage people to do things that is right. If it is right, you'll be accepted. Remember, I preached last week Sunday. Okay, and of course, she didn't finally, the Lord called her home. And when the Lord called her home, guess who gets stuck with that bill? Thank you.
Wow.
And they are saved folks too.
Yes, we have to cover ourselves. So if we look at insurance, the definition says a practice of or arrangement by which a company or government agency provides a guarantee of compensation for specified loss, damage, illness, or death in return for payment of a premium. Okay? With scriptures that we want to take a look at them right there. But anyway, Proverbs 22:3 says, a prudent man sees danger and takes refuge, but the simple keep going and suffer for it. Okay? John 16:33, I have told you that these things so that in me you may have peace. In this world you will have trouble, but take heart, I have overcome the world. So everything's not guaranteed to be perfect. Okay? There's going to be issues. And of course, we know Job, man born of a woman of a few days and they're full of trouble. And what I found interesting is that Proverbs 22:3 is the same as Proverbs 27:12. Okay, the prudent sees danger and take refuge. So we know that something is going to happen. The thing that we don't know is when. We don't know when Jesus is returning. We don't know. And that's why we have auto insurance, because they make us, but at the same time, we don't know when and if we'll ever need it. Health insurance, there was a procedure that was, I don't know if I won't give you all the details about it, but what I'll say is that there's this procedure that costs $90,000 if you don't have insurance. With insurance, it's $500. Okay, that's a big difference that health insurance can make. Okay,
A procedure? What do you call it?
it's stress. There's a basic stress test, and then there's what they call a nuclear stress test. Okay, so if you do the nuclear stress test, it's $90,000. Okay, if you don't have insurance.
Pastor Donna, is the health insurance is the same in all the states, or is just Massachusetts that expensive?
Actually, that's a good question. It may vary by state, but it's still going to be somewhere up there. Because what it is, they talk some of the states talk amongst each other. They have a whole board that talks, so they're probably in the same proximity, close to it.
Yes.
Oh my goodness.
And deductibles 500 everybody, so you have to pay 500.
Yeah,
Because most insurance deductibles are 500, right?
most insurances.
Deductible,
It varies.
something happens, yeah, right, but, it's kind of like in most insurance cases, like cars or something.
Well, with cars, they're usually around 500 to 1,000.
Yes, but also too, and some things in your house, like, insurance, home insurance, like, for example, things like, if a tree fell down and made a little hole in the roof, because it happened to me. And because of the fact I had just had the roof done 5 years ago, they came and they said that, oh, well, your roof is fine. All you have is this little hole. And we don't want to charge you the $500 for it, but that's what it is. And I says, well, my son said to me, Ma, I will go out there on that roof and put down that stuff, whatever you call it, that was on TV. And we placed that on there. We came around, and when he came back, he looked at it. He said, well, that would work too. He said, but if at least anything happens, call me and we'll give you 500. I said, no, just take the 500 and come and fix it, please. But yeah, everything is usually mostly 500. So they must have just paid the 500 instead of the thousands of dollars, right?
Yeah, but depending on the negotiated rates, okay, with the insurance companies, there's rates that are negotiated, so it might be 90,000, but there's some insurance companies say, no, I'm not going to pay the doctor that amount. You're going to get X, and then you end up paying the deductible or the copay or whatever it is. Okay, and okay, all right. So that's health insurance. So going back to life insurance, right now there's about 59% of the people actually have life insurance. Most people don't think they really need it, and so at this time, actually, let's go through this exercise. I got a nice little board over here. So why don't we need life insurance? Why do people think we don't need life insurance?
We walk by faith.
Not gonna die.
It's not their problem, it's the person behind it.
Yeah, some people say, well, when they die, that's it. They're not thinking about taking care of other people having to pay stuff for them.
So let
I've heard
other people worry
say-
about it?
Yeah, that's, I've heard people say that,
That's not my problem.
but it's.
Okay, anything else?
They say they have blessed assurance.
Work or worry? Work, I mean work or worry?
What'd you say?
Do you worry or work?
Or let people
Oh.
worry. Okay, what else?
I heard people say that, when I'm dead, I don't care. Throw me in the street, big car run over me.
Don't care.
It's a lot of
Which
people.
is ridiculous. I heard someone say that.
Okay.
You say, why don't people have health insurance?
Life
insurance.
But I think it's,
Or that old saying, just put me in a box, wooden box.
Cost, okay.
Yeah.
Cost. What else?
I think it is education. I think that people are just not,
Uneducated?
I don't think people are educated about it, and there's a lot of people that don't really understand. So, people need to, sessions like this need to just become knowledgeable of what it really is for. Because we've known for so many years that it's funeral and all this, but it's a lot of times if you have, you know, someone, you know, it's income replacement sometimes when you have a loss in your family. Like if my husband was to pass away, God forbid, but if my husband was to pass away, that it becomes income replacement for, so that you won't be stressed out trying to live after they've lived. So a lot of people don't have a knowledge about what it really is for. It's not just funeral costs, but it's also for, you know, to your you know, for your life after that person passes away. Because you don't want someone to die and then you're in a hardship and you end up on the streets.
Right, right.
So I think part of it is being educated about it.
So Pastor Terrence is then Deacon Jennifer.
It also depends on the type of insurance. I actually just refused to stop paying one of mine because I had it for almost 30 years and I was paying $32 every 3 months. And the minute I turned 60, it jumped to $165 every 3 months. And then it went up to 200 and something. And I said, okay, I'm not paying this anymore. So I got a cancellation letter the other day. So I just let it go. And my husband also had one, and his went up to when he turned 60, and then when it went up to 300 and something every 3 months. I stopped paying it, and I called him and I said, well, can they give us any money back?
No, you couldn't cash it.
I said, because it was term.
Oh,
Yeah,
yeah.
He said,
We're gonna talk about
lunch.
that. We're gonna talk about that.
he said that, if I want to reinstate it, I can come up with $1,000. And, then they could talk about it. So I stopped paying that one. And now it was my turn. And I called and I said, well, can I get any money out of this? I've been paying it for X amount of years. And they tell me no. So I said, forget it. I'm not paying them $200. And then it's my birthday, this birthday's gonna jump up almost $300. So I stopped paying it. So that was like a waste of money. I should have put that $200 and something dollars in the bank every 3 months, and I would be better off.
Yes, we'll talk about, we'll go through that piece of it and why term insurance. Think Terrence?
People don't have life insurance because they think of it as death insurance. They start buying it, it's really looking at death.
Yeah, that's something to get into. And
And
Pastor
people
Donna,
don't like to talk about that.
right. And Pastor Donna, the other part of the educational portion is what her experience is. That people need to be educated about what type of insurance, because so many years people that were selling the insurance was really not selling you the insurance that you needed. They were just trying to get your money, and then you get to a place where she is now, there's no insurance, and then you have these high premiums. So people have to understand what it is that they're buying, and just really knowledge about it.
Okay.
Really.
All right. Any other comments?
I think some is just can't afford it.
Okay.
Cost.
Okay.
Oh, you have the company.
No, that's fine. That's fine. Makes it more important.
Yeah.
All right. So let's go. Let's think about that now, because you see all the reasons of why not. Okay. Let's look at why. Why do we need it? And that's 8. This doesn't work today. Oh wow, this is not good. So why do we need insurance? We had income replacement. What was the other thing?
Children,
What about children?
like say if you have small children and you die of cancer and you don't get to see them grow and they're real small. Because I knew a family like that and they had 3 and they were all under the age of 6. And the mother was dying, the father was going around, and they didn't have money to even bury. And so people in the neighborhood had to get together for that. But the children, they didn't have no insurance, anything for the children. So family took them, but we don't, she didn't have money to bury us. How do you get insurance so that the children have some money to go on wherever they go with?
Anything else?
So your relatives don't get stuck with the bills.
Protect family. Okay. What about the mortgage?
Yes.
Protect profits, does it protect your property, is that what you're saying?
What do you think?
Protecting property,
Assets.
What do you think?
asset, yeah.
Protecting mortgage. Okay. Elaborate.
Well, I mean, isn't there, I don't know if it's a rider, I don't know what it is on mortgage insurance, but isn't there a way you can build in that if, let's say if something happens to, a family member and the mortgage is in their name, then that benefit will take care of that mortgage? I don't know if is that a rider?
Well, there's a couple of
There's
things.
a way you can do that?
Yeah, there's a couple of things you could do with a mortgage. You can get mortgage insurance. Okay, so if something happens, the mortgage insurance is paid off. That insurance pays it off. Or you can get life insurance, and sometimes it's cheaper to get life insurance. And so if something happens, you take the life insurance money
And pay the
it off.
mortgage.
Pay off the mortgage.
Which a lot of times, but wouldn't that be better with the mortgage insurance though? Because the life insurance, a lot of times, the higher policies that we get, sometimes people can't afford it.
Well, it depends.
Yeah.
We'll go through that
Okay.
in the next series. Okay.
There's also an emotional side to it. There is a peace of mind that comes with coverage.
That's good.
That's good.
Peace of mind.
That's
good.
impressive because that seems so esoteric.
Yeah.
So if you, most people don't think about that. Okay.
The younger you are, the cheaper the insurance is. So
Right.
if you get it, like it is. Like I said, I paid $32 every 3 months for 30 years, and now I'm old and need it, and I ain't got it. So it's cheaper if you get it when you're young.
Anything else?
Peace of mind.
Peace of mind. Okay. Protect the family. Okay. Okay. To pay off the debts, pay off bills. Okay. Pay off debt. Okay. You may.
That'll work too.
Okay.
But can you also use this as an insurance as a benefit? Like if the type of policies that you get, you can get cash.
Yeah, we're gonna
There'll
talk
be
about
some
that.
cash incentives.
Yeah, we'll talk about that one.
Okay.
Charity.
All right.
If you want to donate to charity. Okay.
It can also be an investment.
We're going to talk about that a
Investment
little bit
slash
more.
return.
It can be an alternative investment. It's not really, because I'll save it.
Okay.
What about liability?
Liability for what?
Somebody slip and fall on you.
Okay, so that's liability insurance. That's liability insurance.
It's not life insurance.
Yeah, okay.
What is that?
What happened?
Legacy planning?
Oh
Okay.
God.
You know, the Bible talks about leaving an inheritance for the
Children's children.
Yeah, children's children. Okay, legacy planning.
Which, would that be like similar to like retirement? Or the other person's retirement, like person
Yeah, the other-
that's living.
That's
The
living.
person, legacy planning.
For the other person's retirement.
Yeah,
So
like,
that's like income replacement.
that is, yeah, it is, it's back to income replacement,
Okay.
you're right.
All right. So legacy planning, investment, charity, paying off debt, peace of mind. Okay. Anything else? Okay, we got child care.
Tax planning. Tax planning.
Yep, tax planning. So if some people are living in the gentrified area, their property values are going up. Okay, so in Massachusetts, and probably Deacon Wayne can talk more about that, is that the estate tax, any a penny over 1 million, you have to pay estate taxes on it.
Oh
So
my
the
goodness.
property values in the gentrified areas are going up significantly.
Yes.
So what you could do is with your life insurance policy is that money could be used to pay the estate taxes, so that way your children or whoever the beneficiary is can have the not have to pay the estate taxes, and don't have to sell the property to be able to pay the estate taxes. Okay, so those are some of the reasons why people get life insurance. Okay, so it's not all about your final expenses, but it's also about the whole leaving a legacy, taking care of debt, and the whole concept of people saying that, and people don't realize that when there's no money around, when someone's gone, it creates anxiety for the family and battling back and forth. Who's going to contribute what? Why do I have to contribute this? And how much are you going to give? And so all the infighting that takes place after that. So it's really important that resources are set aside for family that has to deal with it afterward.
That's right.
Yeah, because families have split up because of that.
That's right.
So,
And that they do but when families do come together, that they do it, because there's really no checkpoint. Because my mom, when my grandmother passed away, my mom and her siblings got together and they all had a portion. So somebody was paying for this, somebody was paying for the headstone, and they all had commitments. And my mom and I, when I went to purchase a home and I wanted to put her on the home, they told us that she had a judgment against her. We had no idea. What happened was they came together as a group, so all of them was responsible. One sibling did not pay their portion. And over the years, it was like 10 years.
wow.
It started out like a little small thing, like each one of them had to pay like $30 a month, something really small. So over the course of 10 years, she had a judgment, and we had to go to court. We had to do so much, and I couldn't put her name on the house because then I wouldn't have been able to buy the house. But it was sitting there, and they didn't contact her because the sibling was the primary person. And then the sibling ended up passing away. So that judgment was sitting there in the court against her credit, but she never went to, she didn't need to go get no credit to pay for anything, so we never, knew anything about it. So those are the types of things that you have to, people don't do what they say they're going to do, even if it's their parent, their sibling. People just won't pay the money. And it had grown so big, it was ridiculous. And I was like, and I think I ended up having to pay it, but I don't know what happened. But the bottom line was, so you never know. That's why people need to get insurance and get that done.
Yeah.
Get it done.
Okay. So these are the reasons for it. So let's now talk about the different types of insurance. We have, before we get into the nuts and bolts, let's think about group insurance versus personal insurance. Anybody know what the difference is? Group insurance versus term insurance. Not term, personal. Group versus personal. Group and personal. It has to do with job. What? So, right. Well, Personal is your own personal insurance. Group insurance is usually through the job.
Yeah.
And typically what happens with the job, you can get it really cheap because what they're looking at is the whole organization
Yeah.
when they do looking at the underwriting. So what you get is a certificate of insurance. You don't actually get an insurance policy, you have a certificate of insurance. And it's cheap because it's the whole organization, okay? So when you leave the job, typically most insurances you can't take with you. So the challenge is that when you leave that job, you're older. Okay, especially if you've been there for 30 years. And so you try to get insurance when you're older, it's gonna cost you a lot. Okay? So where personal insurance, if you get your own insurance policy, you can take it's yours forever. You determine how much, depending on when you get it, you have, whatever the premiums are gonna be, but it's yours, you own it, you decide what happens with it. And so I encourage the, especially young people, is because they're changing jobs all the time, because insurance is really inexpensive when you're younger, so you might as well just get it while you're young. I'm sorry, don't take it personally. See, the challenge is people don't really think about it, because I think about, I will share this, when Pastor Terrence and I were younger.
Just a couple of years ago.
Just a couple of years ago. We had an insurance policy, and we ran into some challenges trying, because we had just had a child and trying to make ends meet. So I said, we don't need that. Big mistake. Big mistake. When I think about how much money would have been sitting in that policy today. Knowing what I know today, it's like I just kick myself. I try to say, okay, just forget it, let it go. But every now and then it's like, but so we don't take advantage of what's out there because we don't really understand it.
Pastor Donna, what's your opinion about those insurance companies that offer reduced rates for seniors, like if you're over 50 or 55?
Any of those, you have to really read between the lines, okay? Because what happens is that they're low for a period of time, and then they start going up. Okay, so you have to really read between the lines. And there's a phrase that I need you to write down, and always have it with you. It's called enforce
Illustration.
Right. I taught you well. Invoice illustration, okay? You have a policy, you want to review it, especially if you have what we call and we'll talk more about that, a permanent insurance policy, whether it's a flexible premium, universal life, a whole life. You always want to get an in-force illustration, at least every couple of years, to see how the policy is performing, okay? Because some policies, the way they're designed, is that you design them right at the beginning, but then if the cost of insurance goes up, then they take the money, like in cash value policies that are universal life flexible premium. So once the cost of insurance goes up, they take it out of the cash value. So eventually that policy could lapse on you. Okay, and then by the time you catch it, that it's gonna lapse, it's gonna cost you an arm and a leg to reinstate the policy.
Wow.
Okay. So they're not really designed to be ignored. And we typically get them and get the policy, oh, okay, sign on the dotted lines and throw it in a box somewhere. And we say we got insurance, but don't realize what we got.
I have another question regarding the insurance companies. It's highway robbery what they're doing.
Yes, sir.
They expect you to get the policies when you're young. When you get older, it balloons. But in my case, what I look at, even with my past history of health issues, most of these companies won't even touch me. Even though I'm still alive and I'm still here, as you know, after what, almost 27 years of being a cancer survivor, it's like they still will reject me. And I'm like, I'm here for 27 years after I've been diagnosed, and that's still not good enough. So I'm just wondering, what other options do I have?
Well, there's a couple of options. You could do, actually, I might have a solution for you. There's some companies out there that are insuring 1099 employees, people that are 1099, and there's no underwriting involved. So if you're 1099, you go through no underwriting. Usually, if you're working for a company, you can get insurance without any questions. But now, if you're a 1099 employee, means you're not
But
working.
that insurance only exists as long as you're employed by that company, is that correct?
Yeah, if you're working for a company, but not the the one I'm talking about, the 1099 insurance.
It's individual.
It's individual, that's individual.
Okay.
So if you're a 1099 from someone.
The company I work for, it's long-term care group, and we do the scheduling for all the insurance companies. And there was an incident the other day where the agent called, and he wanted to know, why the husband interview was 45 minutes to an hour. And then when the wife got her interview, it lasted 5 minutes. So I didn't know why that happened. So I had to get in touch with underwriting department to find out. Come to find out, the wife was so high and so big, and the interview shut down immediately. So that means they turned her down because of her height and weight. So that's something that they look at also.
Right, they look at health. Actually, they don't call it discrimination anymore. Okay? Let me explain something. It's not called discrimination anymore because they do it to everybody. And so that's why insurance companies don't want to, or the rates are high for someone that's a higher risk. Okay? Because they're taking on a lot of that risk. So they feel justified in having higher premiums. As far as what I was saying about it's not considered discrimination anymore, because it used to be that African Americans, black people, they would automatically have higher rates, okay, because they view them as violent, having a lot of kids, all kinds of stuff. And then it wasn't until, actually it was in the 1900s, probably in the 1930s, 1940s, before we can actually get insurance, real insurance that was not supposedly not biased. But in some respects, it's still somewhat biased because they get your medical history, so they know what's going on, right? So they kind of know what's going on in the background. But initially, the only thing people could get insurance for, black people can get insurance for, was for burial insurance, so they could be buried with dignity. Okay, while the whites were able to get insurance that was going to serve as retirement resources, leave a legacy to their family members, and all we could get was burial policy. Okay, so significant progress has been made. There was a campaign that was ended a couple of years ago where there was about 50 million poured into the community in terms of life insurance, so people could leave a legacy for their families. Okay, because that was the only way people knew back then how to leave a legacy, how to leave something for them was insurance, because if they got it when the kids were younger and they grew, the policy grew, or whether they got a lot at that time, they had something to leave because they didn't have businesses, they didn't have other resources, so life insurance was a way they could leave a legacy. So, going back to what you were asking earlier, you have term versus permanent insurance. Okay. All right. Now I'm gonna go on this side. What did you say?
Permanent.
What is this? Tell me, everybody. Permanent. See? See, you know what it means. I'm abbreviating.
Is permanent the same as whole?
Yeah, we're gonna break it down.
We got you. I got you now.
Okay.
Acronyms. Go ahead.
Yes.
She's talking to black people.
Permanent. Permanent.
Okay, term insurance. Generally, with a term policy, you have what we call level premiums. Premiums, they're level for a period of time. Okay? They're level for a period of time. It's generally cheaper than permanent. Okay? And in your policies, typically they're level for maybe 10, 20, or 30 years. Okay? I don't know if you see that, but anyway, 10, 20, or 30 years. And what happens though, in the policy, they might say expiry, X-P-I-R-Y, 90, at 90 years, okay? that's when it expires, but that's not when the price goes up. The premiums go up. So with the term policy, it's designed primarily for a temporary period of time. Because typically, a family of 4 needs close to $2 million worth of insurance when the children are little. And so you only need that during the time that the kids are growing. So that's about, till they're 21, or if you have a mortgage, till you're about 30. And then you don't really need the policy that much money anymore, okay? So what you have to look at in your policies, they usually have a schedule that says year maybe 1, 2, 3, and then it keeps going down to maybe, let's say 20. And it might say, let's say a year, $1,000 a year, okay, let's say, all the way down here. And then what you'll see in year 21, it goes up to 2,000. Year 22, it might go up to 3,000. So that's what you want to look at.
It doesn't stop. I mean, as it moves from year 1 to year 10, it's 1,000. So when it moves to year 21, it will jump another 1,000.
Continues to jump until
That's
90.
That's exactly what happened to my policy.
Yep. Yep.
You're saying increase in premium or increase in benefit?
Increase in premium.
Premium.
The benefits don't. So
The benefits don't?
no, the benefits don't go up. So if you ran the numbers, that policy would cost you over $1 million.
Did you get a benefit rider though?
If you,
Could you add an increase in
it depends on the
benefit?
company.
Yeah, that's what I
It
was.
depends on the company. Yeah.
That's what happened. And then mine started to go up every year after I turned.
Right. So
Yeah.
so it's probably somewhere down here. It just
Yeah.
keeps going up until the
And
policy
it was the
expires.
same amount of money. They didn't increase.
Right. Right. So you end up paying more for the insurance.
Yes, so that's why
More
I said, I don't
for
want that
less
no more.
insurance.
Yeah.
But don't they give you an option to convert it to permanent during that first 20-year period?
Yeah, they do give, companies usually give you an option, but if you're not paying attention to it, okay, then you miss that window. There's a lot of people that miss that window. Yeah. Yeah, so those companies do give you the option. Usually you'll send it within the 10-year period. It's usually 1 to 10 years. You have the opportunity to convert. And it also depends on when you got the policy. So if you got the policy when you're older, you might have less than 10 years to convert. Okay?
But can you get a term policy that does not increase, premium does not increase?
No.
Not anymore.
No. It's going to increase whether it's, like I said, whether it's 10, 20, or 30 years, it's going to eventually increase after that term.
Unless you die before that term.
Yeah.
Then it won't increase.
Yes.
So for someone that is younger, you have to wait for 10 years.
No, you don't have to wait for the 10 years to convert. Okay. So typically, some people, if they can't afford the permanent policy, or now is not a good time, you want to take advantage of that opportunity for that 10-year window, and so get yourself positioned so that you can convert it to a permanent insurance policy eventually. Okay.
But would it be better, so instead of getting stuck in doing a term policy, because term policies usually are like $10 a month, so it is really inexpensive. However, if you did a permanent and just did, so instead of doing $250,000, you do 50. And that would be a lot cheaper. It might not necessarily be the $10 a month, but it would be a lot cheaper than, you getting stuck in the whole term.
But it depends on the need. Okay. It depends on what the need is. Okay. So like if you're trying to protect your family, the $50,000 policy won't work. And so we're going to talk about trying to assess what the need is after we go through this. Okay. So if all it's just you have no responsibilities, no bills, no debt, that'll work. Okay. But if you're talking about taking care of a family and trying to leave something for your spouse, it may not work unless you have other resources.
So we might as well just tell family, just get ready, they gonna
Let's look at permanent, see? Alright, so if we look at permanent, we'll talk about the two main umbrellas, okay, that typically talk about. You have your whole life, that's WL, whole life, is that okay?
Yeah.
Your universal life.
Yep.
Okay? Both of them have cash value and some type of benefit, cash value. Okay. They're typically level premium. Okay. Net P means premium.
Level P.
Okay. So, but what happens with this one is that this pretty much stays level throughout. Now you can get these where you pay it till you're 100, you pay it in any period less than that, or you could get to year 20 and say, okay, I want to pay it up. What's it going to cost me to pay it up? Okay. You have a cash value that grows with it, but what happens with the cash value? Depending on the company, you get dividends as well added to the policy. Okay.
That's nice.
But what happens is that if you have a cash value, let's say you have, let's say 20,000 cash value, okay, maybe 100,000, that's kind of low. Just work with it. 100K death benefit, okay? All right. If you you could take a loan this out. Let's say you needed to fix a hole on the roof. You took money out of it. You could potentially not pay it back. Okay, but you'd have to pay interest on it. And if something were to happen and you died prematurely, they would subtract the loan from that. Let's say you took 10,000. Okay. Let's say you took 10,000 out, so that would be down to 90,000. Okay. All right. The challenge is with this is a great concept. Okay, but people have to be aware of what they're doing when they take out the loan. Okay, so whatever company you're working with to take out the loan, you need to understand the consequences of not paying it back
It affects the
and all the
face amount.
details. Yeah.
It affects the face. Face value.
Yeah, so you have to be really aware of what you're doing, because there's ways to. I just worked with actually a couple of people too. They had a loan with one company and removed it to another company, and that way what happened was their loan payment was reduced. What they had to pay into the policy was less. Okay. So there's ways around it, but you have to be aware of what you're doing when you take out the loan. And they generally don't recommend taking out a loan until after the policy's been in force for 10 years.
Okay. But how long does it take, like say you took that 10,000, okay, but how long are they saying that it'll take you, that they will give you in order to pay it back?
Oh, you can pay it back, take as long as you want to pay it back.
As long as you're alive, you can.
Yes, as long as the policy stays in force. Okay, as long as you're paying the premium, the policy's in force. Because depending on the size of the loan, if you're not paying the loan, okay, they're taking out the interest, and your policy could end up lapsing. Okay, so that's why you have to be aware of what you're doing, how much you're taking out, what your plans are for paying it back.
So you're paying more interest, so then the pot that you took out,
Yeah.
you're paying more the interest plus that?
You're paying your premium and
Interest on the loan.
Yeah, paying the premium and the interest. And then if you're paying back the loan, you're paying back the loan.
Okay.
Okay, but it's all yours. You're basically being your own bank.
I have a question. When you pay the loan back, the interest you pay, does it go back towards your pension, or that goes to the company?
That goes to the company.
Oh. But it's your money, you use it.
Yeah.
So why the company taking the interest?
For the convenience.
Because they loan you money.
Yeah, but it's what they
Because what you're doing, basically what they're doing is they're saying, okay, let's say this is a mutual company, so they're paying you dividends. So some companies, what they do is they're paying you dividends as if the money was still there. Okay, so the net impact is probably like a 1%, 1 to 2% interest that you're getting, because they're still paying you as if the money was still there.
But they're charging you more in interest.
Well, they're charging you interest. Yeah.
So I have a question. So is term insurance stay term insurance, or it converted into permanent
Okay,
insurance?
it stays term until you say, I want to take some of it or all of it and make it permanent insurance. Okay, so let's say if you had a $100,000 term policy, well, most companies won't go less than $100,000. Let's say you had a $200,000 term policy. Okay, if you had a $200,000 policy, okay, what you could do is say, okay, I want to leave 100 as term and convert 100 to permanent. okay? Or you can convert 100 to permanent and just get rid of the term. Okay, so basically what you've done is create a pool of money to work with, okay? A policy to work with to convert it. Okay? Alright, so let's take a look at universal life. Okay. And this is one that goes by a lot of different names. That's why I say you really have to know what your policy is. Okay? So what happens with this one? This. Let's see how good my artwork is. Is that like that?
What is it? What is it? What is it? Oh my goodness. What is it?
It's the base. So, whirlpool. Stop talking about my drawing. My feelings. Alright, so what happens is that you have a cash value. I'm going to put it down here. Anybody see that? Everyone sees
CV?
down here? CV. Okay. And then you have the cost of insurance, and then you have miscellaneous expenses. Okay. The thing that's good about people like this policy because of the flexibility. So some months you don't want to pay it, you don't pay it. Next month you pay it, you have more flexibility as far as your payments. Okay. But what happens with this policy is as you're paying the premiums, you're putting the money into the policy. Okay, some goes to the cost of insurance, some goes to the expense, and you'll see that on your bill. When you get statements, you should be able to see what's cost of insurance, what's expenses. And then the rest goes down here. Okay, what's left goes here. Okay? So it continues on, and it goes down here. But what happens is that as the cost of insurance goes up, if expenses go up, they take it out of here.
Goes down.
Right.
That goes down.
The cash value goes down. Okay. So this goes down. And so once this starts going down and you don't have enough to cover, your premiums aren't high enough to cover this, yes, your policy's gone. So, but see, everything serves its purpose, okay? So there's, somebody wanted flexibility. So these policies you just have to pay attention to because at some point you may have to increase your premiums, okay? And it's usually later in life that you have to pay more. Okay. Yeah. But that's basically how those work. So with any insurance policy you have, you want to make sure that you know what kind it is and what it's going to do. Okay. What does it do? How does the premiums, what happens with the premiums? Are they going to go up? Are they going to stay the same? And like I said, in-force illustration. You can ask for one of those. Okay, some people will ask you a bunch of questions about it, but you're entitled to one. Okay? Any questions about that?
I have a question.
When did you start accumulating money in the whole life insurance?
In a whole life, typically a whole life insurance, you start accumulating in year 3. Typically year 3, unless you transfer money into the policy. Unless you put extra money in the policy.
But
Usually
you're really not accumulating it, you just put your money in there.
Yeah, it depends, because if they're a dividends company, then you are getting some of the dividends into the policy.
Oh, okay.
But usually they don't, a lot of the money goes toward the cost of insurance. And that's why it's usually year 3, year 4 when you start seeing cash value in the policy.
And could there be discrepancies between dividends that's paid on your account and if you took out a loan, the interest?
Could there be a discrepancy?
Yeah. Between the interest
Okay, go ahead.
on the payment of the loan you took out
The interest?
and the dividends that's paid
Mm-hmm.
if you didn't take out the loan.
Would there be a difference?
Yeah.
Let me make sure, hopefully I got it right. So, if I don't answer your question, let me know. Okay, so, how do you say this? So you have dividends, Okay, by the way, dividends aren't guaranteed dividends, that's for dividends.
They're not guaranteed.
No, they're not guaranteed, by law, you can't, no corporation can guarantee dividends.
Just do DIV.
DIVE.
But the interest of
You know, this CIV.
Alright, dividends.
Dividends.
Alright. So you're saying you took out a loan, right?
You already answered my question. So even dividends are not guaranteed.
No.
But if you took out a loan, the interest on that loan you take out is guaranteed.
It's guaranteed to the bank.
Straight up, yeah.
It's their money.
Yes, that is your question. Yes. By the way, I used to be an excellent speller.
Pastor Donna, I have a question.
Yes.
My question is, would you be better off opening? Would you be better off opening an account at the bank and just put that premium every month in there and save this up?
It depends, but see, the difference is this, okay? Alright.
And don't touch it.
Okay, let's look at it this way. For example, the question was whether it's better to put the money in the bank, okay? The challenge is this, okay? This is day one, alright? Day one, you put money in the bank. What do you want to put, $100 in the bank?
Yeah.
$100 in the bank, day one. Okay? By insurance policy, let's say your premium was, what's your premium? Let's see, 45-year-old, let's say it's a term, what's that, whole life policy, okay? Let's say $90, no, let's do it this way, let's make it bigger, okay? Just to make it worse. Let's say you're 65, okay? And you put, $234 in a policy. Okay, as soon as you put that money in a policy, you have a $50,000 death benefit. Okay? Here, okay, you only put $100 in. If something were to happen to you on day two, you have nothing. Okay. So the challenge, if you're trying to self-insure yourself, what you have to figure out is how much you can set aside as quickly as you can, to some degree, because I don't know. Last some final expenses I dealt with was it cost about $12,000.
Yes, correct.
Okay.
Yeah.
Alright, so you want to set aside at least enough for that, then you can cancel your policy. And you have to be the type of person that's disciplined. Sometimes we lie to ourselves and think, I just say it, that's what it is. It's like with credit cards. We say we're going to do this and do that, and we don't do it. So you want to, that's how you can self-insure yourself. Get a term insurance policy temporarily. Save up some money, lock it in, don't do anything with it, then it's there. But you have to make sure that something happens to you, somebody has access to getting it out. It's okay.
And that they're gonna do with
That's
it
a
what you
whole
want
nother,
them to do.
that's a whole nother thing. That's a whole nother thing.
Alright?
Now, over the insurance policy, you have X amount of goals to cover you.
Yes. Alright. So what I gave you is a little exercise, and well, let me just go to the top chart. Age and health makes a difference. Basically, what that is an example of what happens at different age groups.
Right.
Okay? So with the whole life policy, if you had a child age 1 and you put in a $50,000 policy on, that would be the monthly cost. Okay? So by the time they were 70 with dividends and interest, their cash value would be $104,000, and their the benefit would be $184,000. Okay. All right. And at age 25, you do the same thing. That's the cost. All right. And you're up to $45 a month. All right. And then you see how it grows to age 70. Okay. So at 65, all right, 234. All right, 234 months. And this is somebody that's in good health. Okay, but many people at age 65, they have other issues. So that cost would be more. Okay. And then if you look at the term policy,
Same thing.
okay, same thing. All right. So that's why it's best. The younger you are, the healthier you are, get insurance at that time. Okay.
See how many young ones you got in there?
But the challenge is like the young people don't know what they're going to do with their life yet. So it's like catch-22. But some people just get $1 million policy and put it in place just because it's cheap. Okay. All right. Okay. How much do you need? Okay. Only you can answer that question, right? But I'll walk you through it. Walk you through a thought process. So if you think about it, if you're married or single, thinking about getting married, you have to think about what do you need. Goes back to needs and wants. Okay. Versus what you want. Okay. Okay. If you when you think about your needs, you have a spouse. It's like, okay, what lifestyle do you want your spouse to be left with? Okay, what kind of lifestyle do you want him or her to
I
have?
want them to be sad because I won't be here. I want them out there galloping, enjoying the trip and all that. And I'm
So hers is 0. It's 0. Well, wouldn't that depend on what the income does for the family? Let's say if you had, husband and wife situation, and the husband is has more of the income, and then the wife income is less. I mean, do you really need all that money? Like for an example, if let's say the luxury of the spouse's income is for I'm just saying luxury, you guys. It's for butter, for stuff on the side. Like you need it, but you just use that for stuff that you want. So if that spouse passes away, the income of the other spouse is not really impacted. So would you need to get $100,000 or $50,000? Would you just need to pay for the burial and have a little change on the side and keep it moving? Or should you because it's really not, that person's not contributing to the whole anyway. So would you need to take that money out of your income to purchase something that's really, I mean, it'll be extra, but do you really, really need to spend your money that way? It's just that question.
It depends on you and the spouse.
Right.
Okay? It depends on, that's where you really have to have the conversation.
Right.
It's that, okay, if you really don't need this money, then maybe you don't need to get a large insurance policy. So it depends on, like I said, the lifestyle that you want the other one to be left with. Okay.
I don't think you should ask that question.
Well, even for the kids, like you get the policies for the children, don't you get minimum for the children? And then when they get old enough, they get their own.
But it's better to get, well, you would have to speculate how much you get. Because the challenge with kids' policies is that they look at the parent, and some companies, insurance companies, let's say I wanted to get my child a $200,000 policy, for example, they'll look at me and see what size my policy is. And so if my policy is less than the kid's policy, they may not approve it. Okay.
Wow.
Right. Some companies will not approve it. Yeah, so you want to look at the lifestyle that you want to leave, okay? You also want to think about whether you want to pay for college, what you want to contribute to the college. All right, what you want to contribute to the college.
Tuition.
What happened?
I said all the politicians are saying it's going to be free, so.
You have income replacement, because so if you're like Social Security and you're going to lose one of the Social Securities, so you might need to replace one of the incomes. okay? So those are all these things might be a need, okay, that you have to think about, okay? And then your wants would be, unless it's a need for you to donate to charity, alright? I put a bunch of them on here for you to look at, okay? Legacy could go here or here, okay, or both, okay, legacy. So you really have to sit down and say, what is it that I want to happen? And it's a conversation that people don't like to have.
Property renovation.
Okay. Now, the reason why I said property renovations, because some people will say, you know what, if something happens, just sell the house.
Yeah.
So when you think about selling the house, do you need to renovate the house? Okay. How long is to sell it. How long is it going to take to sell it? Okay, if it takes 6 months or a year, then you need some resources to cover that for that period of time. So it's easy to say sell a house, but how do you get it sold? Okay.
It's a lot of communication.
Yeah.
It's really a lot of communication. It really is. It's really.
So then once you figure out what is it that you really need, okay, what you need and what you want to happen, then you have to look at also your other assets, so your needs and your desires, your wants, needs and wants, okay. Okay, equals X. Okay, then you have your assets. If you have assets, you know, money in the bank or other resources, you can go to your Y's, okay? And so that gives you your, what you need for a policy. And so when you're thinking about your assets, you have to be careful about what do you have that can be, is easily accessible, okay? So you don't want to count your house in here as an asset, because it takes a lot to liquidate it. It takes time to liquidate it. So that could be money in the bank. You could have CDs. You could have IRAs. Okay. Alright.
And stocks.
The stocks, okay.
Annuities.
Yeah. And so all these, remember when you have the, especially like annuities and IRAs, there's might be different rules associated with that as how it can be taken out. Because some annuities say you can only take out so much over a period of time. Okay, so yeah, so once you do the math, then you can say, okay, this is what I need, okay. Whatever that number is. And so what I was talking about earlier is that term policies, like, they fill a need for a temporary period of time, because if, like I said, if the need, your Z comes out to be, you know, because you got a family of 10 or something like that, maybe it comes out to $3 million. You're not gonna buy a whole life policy for $3 million. It's gonna be cost prohibitive. So you end up what we call layering it. So you might have term for maybe 2.5. I don't know how much money you got. 2.5 million. Okay, and then a whole life policy for 500 billion. Okay.
500,000.
500,000.
500 million.
Yes, 500 million.
0.5 million.
Yeah,
Yeah,
billion.
yeah, right.
That's 0.5 million.
It's 500,000.
There
You see
you
the
go.
point before the 5?
Is it 5 million?
Should
No,
say-
1.5 million.
5K. Come on.
Yeah.
All right.
5K, that's only 5,000.
500,000. Yeah.
I said
was
fi-
right the
I
first
said
time.
I said 500,000.
Be quiet.
I told you 500,000.
5.5 million.
Not 5 million.
Yeah, 0.5 million.
5 million.
0.5
0.5,
million.
yeah.
Right, got you.
Right.
Okay.
Okay. So like I said, depending on this number, that's when you have to say, okay, if I need this amount, what do I need to do? What can I do? Okay, and then if it's too steep, if there's any, the combination of this or something else is too steep, then it says, okay, what wants can I cut back on? Okay, but you want to start looking at what is it that you need and want to happen. Subtract what you have available, and then figure out what you need. Okay, a lot of times we just come up with a number off the top of our head, as opposed to actually thinking about what the purpose of it's for. Why do I need insurance? What do I want to do with it? Make sense?
Wow. Pastor Donna, are these numbers realistic?
What numbers?
Are you ballooning them? Is this realistic? Like for the population for people that we're here tonight, is this realistic? Could we afford this amount of insurance?
I just think that number out there.
Really, is it realistic?
I don't know. I don't know if it's
So
right
what's
here.
no, I'm not saying it from, I'm just saying projecting. But what's a realistic amount of insurance? And I'm not talking about real property, what people have, but what's a realistic amount of insurance that we could target or we could think about in terms of?
I really can't answer that.
So it's not really a realistic.
No, because it depends on you as an individual.
But what's the minimum? What you would think that if you thought that if you would say, this is an amount that
I cannot answer. I really can't answer that question. I can't answer the question.
So could you tell people what's the minimum? What makes sense? No. Should we get 1,000 or should we get 100,000? Yeah.
You can't. No. I can't do that.
What I was told when we were looking to get insurance was, he said it's based on if you have young children. And if you have a mortgage, and you need to have enough to cover those debts. So you don't really need excess. You just need enough to cover what expense you have.
Well, I just did the formula.
Right now.
I said
So that's what
your
you
needs,
just did.
your wants,
So that's what
minus
it
your
is.
assets.
Got it.
Okay, and then that's what you need. Okay, and
Okay.
then if you can't,
So that's what you need
Z
first,
is
then,
too
Gil.
big.
You need
then
Z.
Reduce. You gotta reduce it.
I'm just playing around. I sold insurance for 8
No,
years,
they
so
will
I'm
say-
just playing around.
No,
with
they
you
will
guys.
say there is a rule of thumb where they say, you could spend 7 times your income. There's another rule that says if you're a certain age, this is how much you're gonna have. And there are tables in insurance companies that if you wanted a certain amount based on your income, they'll say no way. But there's some stuff in the background, but this is where you really need to start, is looking at this, okay? Looking at this and figuring out that, and then say, if this is too much, where can I cut back on? Okay?
Z is too much, you go to
I'm sorry, one last question, Shirley.
I just have a question about the insurance. So for someone that is married, like, do you get the insurance together or each person get their own? Is it separate or?
Yeah, there's a couple things you can do, okay? You get separate insurance policies, probably the best to do, okay? Because there's things called survivorship insurance, and that might be set up with the last to die. So the person that's last to die ends up getting it. Yeah.
Can you have Kevin Chin in the front of the
Yeah, but it's best to get it separately unless you really need to get it out of joint. Get it set together.
So Pastor Donna, say your recommendation to all those younger ones that are in here.
My recommendation, get your insurance policy now.
Now.
Best health that you'll ever be in. Best health and best days that you'll ever be in.
Yes.
Okay. All right. Let's close in prayer. Heavenly Father, we just thank you and praise you, God, that you're our source, you're our strength, our ever-present help, Father. We thank you for your wisdom, God, that you give freely. Lord, I ask that you'll take us out to our different homes respectively, God, and that you'll cover us by your precious blood, God, and help us, Father, to be wise stewards of all that you bless us with. Help us to use your wisdom, godly wisdom, Father. Lord, we just thank you for your protection. And Lord, bring us back to prayer tomorrow morning, bright and early, to intercede on behalf of the nations. In Jesus' name, amen.